In this video, we're going to talk about decision making in general, right? So we're going to talk about something called the net present value decision rule. And we'll also incorporate some other decision making theory to discuss how managers ultimately decide what it is they want to buy for the company, to run the company for operations. So the net present value just measures the difference between the present value of benefits and the present value of costs. So this process is really just a very simple cost benefit analysis. So net present value, though, is a very special measure. It measures the change in firm wealth, shareholder wealth. That's what it measures, right? So net present value is just the present value of all project cash flows. But more simply, it's the present value of the benefits, present value of future cash flows, minus the present value or the investment cost of a project. So the basic decision rule is you accept any projects with positive net present value because that's the equivalent of getting that value today in cash. And of course, you would never want to buy an asset and then actually have to pay more money to have the asset, right? So that's essentially what a negative net present value implies. It implies additional funds needed to make this project go beyond what you invested. So it actually measures, if you will, a reduction in wealth of the investors. So we always want to choose those projects that have positive net present values. But what if you have several to pick from, right? You have several, you're thinking about investing in buying some cars or a car for your company. We're going to look at 4 or 5 different makes and models of cars. So you're going to have 5 or 6 choices. You need to choose the one that has the highest net present value. What will that do? That will provide the company, right, with the greatest amount of value for this particular project. So here's a quick little example, if you will. A company wants to buy a copier for $9,500. And as part of a promotion, right, the manufacturer says, look, if you don't want to pay $9,500 today, you could pay $10,000 at the end of the year. So which would you rather do? Would you rather pay cash today or pay $10,000 in 1 year? And if the risk-free rate were 7%, the question is this a good deal? Well, let's find the present value of this $10,000, right? You're going to pay this, right, $10,000, so you'll need $10,000 in 1 year, right? 7%. The present value of that is $93.45. So this is essentially saying that the value of this project is $9,345 if you wait and pay $10,000 in a year. Or you can pay $9,500 today. And of course, you'd rather pay the $93.45 than the $9,500. So you would delay this by 1 year. What this kind of introduces us to is the concept of pricing, right? So we have something called arbitrage. Arbitrage is the practice of buying and selling equivalent goods in different markets at different prices to take advantage of those prices. So this occurs when it's possible for making a profit without really taking any risk then. So there are a couple of definitions here of arbitrage. But essentially, we get to a point where we say that all projects or all assets that are identical should have the exact same price regardless of the market. So in a normal market, a competitive market, in a normal market, there are no arbitrage opportunities. So prices should be relatively close. What this provides for us is some opportunities, if you will, for taking advantage of this. So the law of one price is what governs this arbitrage opportunity. And essentially, again, it is an equivalent investment opportunity should have simultaneously in the same competitive markets. They have to have the same price. So the advantage of this is we don't have to go around and check for varying prices in different markets. For instance, if you wanted to buy 5 pounds of a certain kind of nail, right, you shouldn't have to go to every hardware store in the city to find the place that has the lowest price. They'll all be in the ballpark for the same price, for the same product, for the same quality, etc. So again, this concept of arbitrage and the law of one price is very important for us to understand. So it allows us to not have to shop as much for products that we want to purchase. So in a no arbitrage world, then prices should make sense. Prices should be in equilibrium. So this company says it's going to promise a risk-free payment of $1,000 in a year. If the risk-free rate is 5%, what should the price of this asset be? Well, $1,000 at 5% 1 year out should be worth $952.38. So if this project has a price that's anything different than $952.38, then there is some kind of an arbitrage opportunity. So it's you could either buy or sell this and make a profit instantly just by unwinding that transaction. So if you bought it for, let's say you could buy this for $940, you should be able to buy it for $940 and instantly sell it for $952. So you would make $12 in profit by unwinding this transaction because the price is incorrect. The price doesn't reflect a no arbitrage opportunity. So again, how do we determine the no arbitrage price? Right? So unless the price of the security equals the present value of its cash flows, as we've been saying, arbitrage opportunities exist. So we need to identify the cash flow. We need to determine the cost of replicating those cash flows. So what this means, you need to predict cash flows for a project. You also need to know what is the cost of replicating these cash flows. That is a question about financing, right? So the price of the security has to be equal to the present value of the cash flows, where you find the present value using the cost of financing for those particular projects. And again, as we get into later videos and we start to talk about capital budgeting in general, these concepts hopefully will become more clear. So here's a risk-free bond, pays $1,000 in 1 year. It's trading at a competitive price of $929.80. So the bond's price has to equal the present value of the cash flow. it'll pay, or there would be an arbitrage opportunity. So if we look at this $1,000 present value, there's the price for 1 year. The interest rate, the return, is 7.55%. So we are saying that this particular asset, the risk-free rate of return, is this 7.55% return. So let's dig a little deeper into some decision making. In a normal market, the net present value of buying and selling a security is zero. What this essentially is saying is buying a security is ultimately a zero gain proposition. The net present value of buying a security should be equal to zero. The net present value of selling a security should be zero. So trading securities, buying and selling of securities, neither destroys or builds value. So where does the value of a company come from? It doesn't come from the securities. It comes from the assets of the company. So value is created by the real investment projects of the firm. Right? It is the net present value of projects, of assets, that ultimately creates the value of a company. So we have a theory or a principle called the separation principle. And we're not going to get into a lot of details about the proof of this principle. But essentially it says that there is a difference. There are two different activities. The activity of determining what thing to buy and the activity of how you buy it, the financing, are two separate things. So to evaluate the net present value of an investment, we need to do that separately from how we finance that project, right? What you buy and how you pay for it are two different decisions. So the law of one price, again, allows us to then incorporate the separation theorem. It also allows us to incorporate something called value additivity. So the price of an asset is the price of its sum of its components. The price of a firm is equal to the price of the assets of the firm in sum. So what does this ultimately mean? Well, how can you increase the value of a company? You either increase the individual value of the assets inside the company, or you add another asset. There's only two ways to grow. Make those things that you have more valuable, or add something that makes the sum of the assets more valuable. So let's look how this value additivity could work. We have this publicly traded company, only has three assets. It owns 50% of Do Beverage, 70% of Moon Industries, and 100% of the Oxford Bears football team. Now, Do Beverage and Moon Industries are publicly traded companies, and the Oxford Bears is a private company. So the question is, what is the value of Oxford Bears? So the total market value of Moon Holdings, right, is $200 million. Total market value of Do Beverage is $75 million. And the total market value of Moon Industries, this whole company, is $100 million. I'm sorry, Moon is worth $200 million. Mountain is worth $100 million. So how do we calculate this? Well, we have a 50% stake in Do Beverage, which means 50% of its value of 75 million means we own 37.5 million. 70% of the 100 million of Mountain is 70 million. And of course, they have 100% stake in Oxford Bears. So our formula is 200 million is the value of the entire company. Subtract the 37.5 for Do, subtract the 70 million for Mountain. That leaves us with 92.5 million for the Oxford Bears. So under this value added method, the value of the entire corporation is incorporated into the value of the corporation. And of course, for certain companies, they may have private companies that are part of the corporate company. So how do you find the value of a company that is private? We'll talk about this a little bit later on when we talk about valuing securities. But it is a very important question on how you can find the value of these private pieces of public companies. So again, value additivity and firm value. To maximize the value of the entire firm, you need to make decisions that maximize net present value. And it's that decision represents net present value. That represents its contribution to the overall value of the firm. So I look forward to talking to you in the next video.